back to Boni's Life. Today, we are embarking on a deep, comprehensive, and unflinching dive into the global economy, the traditional financial markets, and the ever-evolving cryptocurrency ecosystem, all under the heavy, unpredictable shadow of the ongoing war with Iran. We are not just skimming the surface here. We are conducting a detailed, rigorous analysis of the best-case and worst-case scenarios, projecting exactly how these geopolitical tectonic shifts will impact your portfolio, your purchasing power, and the entire global financial architecture. The landscape has shifted dramatically since the escalation in late February 2026, and the ripple effects are being felt across every single asset class, from the price of crude oil at the pump to the intraday volatility of Bitcoin on the blockchain. We will break down the hard numbers, examine the intricate technical setups, and provide actionable high-level strategies for traders of all experience levels who are trying to navigate this unprecedented volatility. This is the intellectual deep dive you need to understand where the smart money is moving, how the institutions are positioning themselves, and how you can protect and grow your wealth in what comes next. Let us start with the absolute epicenter of this economic shockwave, the global energy markets. Since the United States and Israel launched targeted, high-impact strikes against Iranian military assets, specifically focusing on the vital export hub of Kag Island, the oil markets have been in a state of hypervigilance and near panic. We have seen Brent crude, the international benchmark, spike as high as $119 per barrel in a fear-driven surge before settling into a highly volatile, unpredictable range around $104 to $106. West Texas Intermediate, or WTI, the US benchmark, has consistently topped the psychological and economic $100 mark. To put this in perspective, this represents a staggering 50% increase since the conflict began in earnest, and a massive economy-crushing 75% rise year-to-date in 2026. The critical choke point here, the geopolitical jugular vein of the global economy, is the Strait of Ous. Approximately 20% of the world's total oil consumption flows through this narrow, easily blockaded waterway. With commercial traffic effectively halted due to the imminent threat of attack, and Iran's Expediency Council explicitly declaring the strait closed to the United States and its allies, the supply chain disruption is not just theoretical. It is severe, immediate, and compounding daily. In a best-case scenario regarding energy, we would see rapid, effective diplomatic intervention or the successful deployment of a massive international naval coalition that definitively secures the strait and forces a quick, face-saving de-escalation for all parties involved. If the free flow of oil is guaranteed and the massive geopolitical risk premium evaporates from the market, we could see oil prices retreat rapidly toward the $80 to $85 range. This would be a massive, much-needed relief valve for the global economy, alleviating the immediate crushing inflationary pressure and stabilizing global trade networks that are currently in a state of disarray and panic. However, as intelligent investors, we must confront the worst-case scenario, a protracted, grinding, multi-front conflict that permanently damages the critical infrastructure on Kag Island or leads to a prolonged, heavily militarized closure of the Strait of Ous. In this catastrophic event, oil could easily breach $130, $150, or even higher per barrel. This would trigger a massive, synchronized global energy crisis, unlike anything we have seen in decades. We would see widespread production suspensions across industries that rely heavily on petroleum products, skyrocketing transportation and logistics costs, and double-digit GDP contractions in Gulf states that rely entirely on oil exports, inevitably dragging the rest of the developed and developing world into a deep, dark, and prolonged recession. This energy shock does not exist in a vacuum. It feeds directly and aggressively into the broader macroeconomic picture, specifically raising the terrifying specter of stagflation. It is absolutely crucial to understand that even before the Iran conflict escalated into open warfare, the US economy was already flashing bright red warning signs. We were seeing tepid, uninspiring economic growth coupled with sticky, persistent inflation that simply refused to die down despite the Fed's efforts. The Federal Reserve's preferred inflation measure closed 2025 at 2.9%, which is significantly above their stated mandated 2% target. Now, inject a massive, unpredictable oil shock into that already fragile system. High oil prices act as a massive, unavoidable, and highly regressive tax on every single consumer and every business on the planet. Because of this dynamic, the odds of a 1970s-style stagflation, a brutal economic period characterized by high inflation, high unemployment, and stagnant consumer demand, have risen dramatically to 35% according to the latest, highly respected analysis from Ardini Research. Furthermore, the probability of a U.S. recession has jumped from a pre-war baseline of 22% to a highly concerning 34%, and that number is climbing every day the conflict continues. The Federal Reserve is currently caught in an impossible bind, a true central banking nightmare with no easy way out. They are meeting this week, and the market widely, almost unanimously, expects them to keep interest rates unchanged. The optimistic, perhaps naive, hopes for multiple rate cuts in 2026, which fueled the massive stock market rally earlier this year, are rapidly fading into oblivion. Traders have aggressively repriced their expectations, taking even a September rate cut completely off the table. If inflation continues to surge relentlessly due to these uncontrollable, geopolitically driven energy costs, while underlying economic growth stalls out due to the immense pressure on the consumer, the Fed may be forced to maintain these restrictive, high interest rates for much longer than anyone anticipated. In a true worst-case scenario, they might even be forced to consider rate hikes to combat the inflationary spiral, which would be absolutely devastating for asset prices. This high interest rate environment, combined with slowing economic growth and a severely squeezed consumer, is a highly toxic mix for corporate earnings, capital investment, and overall consumer spending, which makes up the vast bulk of the U.S. economy. Turning our attention to the traditional financial markets, the impact has been pronounced, but perhaps not as catastrophic as one might expect given the terrifying headlines, highlighting a certain resilience or perhaps a dangerous willful complacency among equity investors. The S&P 500 recently notched its third consecutive losing week, dropping 1.6% and hitting its lowest level of 2026. The Dow Jones Industrial Average and the tech-heavy Nasdaq have also suffered significant multi-percentage point losses. However, when you zoom out and look at the broader picture, the S&P 500 remains only about 5% below its all-time high set earlier this year. This surprising resilience is partly due to highly optimistic, perhaps overly rosy, consensus estimates from Wall Street analysts for corporate earnings in 2026 and 2027. These estimates seem to be largely ignoring the potential negative, long-term consequences of a protracted war and a sustained structural energy shock. However, under the surface, fear is brewing and the smart money is hedging. Volatility measured by the VIX index, often called Wall Street's fear gauge, has surged above 25, indicating heightened anxiety and a massive rush by institutions to buy downside protection. In a best-case scenario for equities, if the conflict is contained geographically, energy prices stabilize quickly, and the Fed manages a miraculous, historically unprecedented soft landing, equity markets could quickly recover their recent losses. This recovery would be driven by strong underlying corporate fundamentals in certain resilient sectors and the ongoing massive paradigm-shifting boom in artificial intelligence, particularly with major events like NVIDIA's GTC conference providing positive forward-looking catalysts that distract the market from the geopolitical gloom. The worst-case scenario, however, involves a brutal, sudden realization of the stagflation threat by the broader market. If higher energy costs crush corporate profit margins across the board and consumer demand plummets as everyday people struggle to pay for gas and groceries, we could see a severe cascading market correction. In this scenario, the S&P 500 could easily drop 15% to 20% from its current levels as valuations are aggressively and painfully recalibrated to reflect the new, much harsher economic reality of low growth, high costs, and shrinking margins. In times of profound geopolitical crisis, war, and rampant, uncontrollable inflation, intelligent investors traditionally flock to hard, safe haven assets, and gold has performed exactly as historical precedent would suggest. Gold prices have soared to near all-time highs, currently trading in a tight, elevated range between $4,976 and $5,121 per ounce. This represents a remarkable wealth-preserving increase of over 25% since the beginning of 2026 alone. The combination of open warfare in the Middle East, deeply entrenched inflation fears, and the potential for a significantly weakening US dollar as the Fed's policy becomes constrained has created an absolute perfect storm for the precious metal. Top-tier analysts and major financial institutions are now confidently predicting that gold could reach $6,000 per ounce by the end of the year. If the worst-case scenario of prolonged global stagflation, supply chain destruction, and geopolitical instability materializes, gold will continue its aggressive parabolic upward trajectory as fiat currencies globally lose their purchasing power at an accelerating rate. Even in a best-case scenario of stabilization, the underlying structural inflationary pressures and the accelerating shift away from dollar reliance by various global actors, the massive de-dollarization trend led by the BRICS nations will likely keep a massive unbreakable floor under gold prices. This makes physical gold and gold-backed assets a critical non-negotiable component of any intelligently diversified portfolio in this current highly dangerous macroeconomic environment. Now, let us pivot and dive deep into the cryptocurrency markets, which have shown incredible dynamism, extreme volatility, and fascinating structural shifts during this period of intense global stress. The total cryptocurrency market capitalization currently stands at $2.587 trillion. While this is down significantly from its pre-war euphoric highs of over $3.5 trillion, it is showing strong signs of recovery and resilience, with a 2.6% increase in just the last 24 hours. Bitcoin, the undisputed king and the primary macroeconomic indicator for the entire digital asset space, maintains a dominant 56.7% market share and is currently trading around $73,381. It is crucial to remember the journey. Bitcoin started the year incredibly strong, pushing above $93,000, but experienced a sharp, violent crash down to $60,000 in February when the US and Israel launched their initial surprise strikes. However, Bitcoin has demonstrated remarkable resilience, bouncing back aggressively and currently trading comfortably above its critical 50-day moving average of $71,125. Ethereum, the smart contract leader and the foundation of decentralized finance, follows at $2,266, holding a 10.6% market dominance. The derivatives market, which often dictates short-term price action and creates massive volatility spikes, is highly active. CoinGlass reports a massive 24-hour volume of $194.73 billion and open interest sitting at a hefty $112.61 billion. The 24-hour liquidation data shows $374.04 million wiped out, indicating that significant over-leveraged positions are constantly being flushed out of the system, creating localized volatility and opportunities for astute traders. The long/short ratio is relatively balanced at 51.42% to 48.58%, suggesting a market that is cautious, highly attentive to news flow, but slightly leaning bullish overall. The institutional adoption of Bitcoin continues to be a major unstoppable driving force, providing a massive counterbalance even amidst severe geopolitical turmoil and macroeconomic uncertainty. We are seeing consistent, relentless positive inflows into the newly approved Bitcoin spot ETFs. For example, looking at the data for March 13th alone, there was a net inflow of 2,560 BTC, largely driven by the insatiable appetite of BlackRock's IBIT product. Since their inception, these ETFs have accumulated a massive market-altering net inflow of over 711,950 Bitcoin. This consistent daily institutional buying pressure provides a strong structural foundation for Bitcoin's price that simply did not exist in previous market cycles. In a best-case scenario for crypto, where the geopolitical situation in the Middle East stabilizes, the Strait of Ous reopens to commercial traffic, and the macroeconomic environment avoids a deep systemic recession, Bitcoin could easily reclaim its previous all-time highs. Driven by the recent halving supply shock, which drastically reduced the issuance of new coins and the relentless daily ETF accumulation by the world's largest asset managers, Bitcoin could push aggressively towards the $100,000 to $125,000 range by the end of 2026. The worst-case scenario, however, involving a severe global recession, a massive spike in unemployment, and a broad liquidity crisis, could see a massive flight to cash across all markets. This would drag Bitcoin back down to rigorously test the $50,000 to $60,000 macro support levels, as risk-on assets are sold off indiscriminately to cover margin calls in traditional markets. Let us get highly tactical and look at the specific technical setups and triggers for the next trades in the crypto market over the next 24 to 48 hours. For Bitcoin, the immediate heavy resistance lies at the $75,000 psychological and technical level. A decisive daily close above this level, supported by strong, undeniable spot volume, would be a massive bullish trigger. This would invalidate the recent bearish structure and open the door for a rapid retest of the $80,000 to $85,000 supply zone. On the downside, the absolute critical support to watch is the 50-day moving average, currently sitting at $71,125. If this level fails to hold on a closing basis, we could see a rapid high-volume descent toward the $65,000 macro support block. Prediction markets currently give a 31.5% probability of testing this lower bound. For Ethereum, the key pivot point is the $2,100 to $2,300 range. This area acted as massive unbreakable support during the June 2025 conflict and is doing so again. A clean breakout above $2,300 could trigger a momentum run toward $2,500. Conversely, a breakdown below $2,100 would signal severe structural weakness, potentially testing the $1,800 deep support level. Traders must obsessively monitor their funding rates on major derivatives exchanges like Binance and Bybit. Currently, they are slightly positive, indicating that longs are paying shorts to keep their positions open. However, any sudden aggressive spike in funding rates could precede a massive long squeeze, while deeply negative rates could signal an impending short squeeze. To successfully navigate these incredibly treacherous and complex waters, traders must ruthlessly adapt their strategies based on their specific experience level, capital base, and risk tolerance. For beginners and those with less screen time, the most prudent, mathematically sound approach is strict dollar cost averaging, DCA, into high conviction, blue chip assets like Bitcoin and physical gold. Avoid the temptation to use high leverage or trade obscure altcoins, as the current intraday volatility can easily and permanently wipe out an undercapitalized account. Your primary focus must be on capital preservation and building a robust, long-term position that can weather this storm. For advanced professional traders, this high volatility environment offers significant generational opportunities. Utilize complex option strategies to hedge your spot positions against sudden downside risk. Monitor the VIX and the global oil markets obsessively, as they are currently the primary leading indicators for broader market sentiment and algorithmic trading flows. In the crypto derivatives market, look for glaring discrepancies between open interest and price action to identify potential. Violent liquidation cascades before they happen. If open interest is rising rapidly while the price is stagnating or grinding lower, a violent explosive move is imminent. Employ strict, non-negotiable stop-loss orders and be prepared to flip your directional bias instantly as new geopolitical headlines hit the wires. The key to survival and outsized profitability in this specific market regime is extreme agility, rigorous emotionless risk management, and a deep, nuanced understanding of the macroeconomic forces at play. Stay sharp, stay informed, trust the data, and always protect your capital. This is Boni signing off, signing